Hi, and welcome to the Stockscores Market Minutes for February 22nd, 2016. This week I want to talk about how news is judged by the market. So I've called this "The News is All Relative." Many investors and traders will consider company and economic news as it reads. They read bad news and expect the market to go lower. They read good news and they expect the market to go higher. What we often find, however, is that good news has a negative market reaction and bad news maybe a positive one. And the question is, why does that happen? Why does good news sometimes mean good reaction and sometimes bad? Well, it's important to understand that news is judged in consideration of how the stock has moved in anticipation of the news. The market will tend to react based on expectations and whether they are met, exceeded, or fallen short, rather than on the facts themselves. So let's use Twitter as an example. Now, Twitter announced their earnings after the close right here. In the extended trading session, the stock was down quite sharply. On the open, it opened down fairly significantly and then started to come back. Now, I had actually bought Twitter the day before, and so in the pre-market, I was a little worried because it was down quite a lot. But I also knew that the market for Twitter had moved down a lot in the weeks leading up to that news. And in fact, if I could show you a daily chart here, you would see that Twitter's shares have really been hammered lower lately. And it was my sense that the market had priced in all the bad news it could. And the news wasn't really that bad. I mean, their earnings were okay. Their growth in users was not as expected, but it felt like those expectations had already been priced in. And the result was that after the initial shakeout, which happened on the open on the 11th, the market started to move higher. And if we use simple technical analysis instead of listening to the news itself, we would see that the downward trend line was broken from a rising bottom right there. And that started the upward trend that Twitter enjoyed this week. And you can see that this is a 15-day, 30-minute chart. So this is Friday, Thursday, Wednesday, Tuesday, Monday, a real big run higher after the negative news. Or Monday was a holiday, so this is Friday here. This was Thursday when the news came out. So the point is, don't read the news for what it says. Try to anticipate or understand what the market's expectations were going into the news, and then judge that accordingly. By the same token, stocks that run up in anticipation of news often pull back sharply because the news isn't as good as the market expects. All right, here is the 30-day, 60-minute chart of the S&P 500. I'm calling this a neutral chart because you can see we've been stuck in a neutral trading range for the last few weeks. Up, down, up, down. We're now at the top of that channel, which means we're more likely to move down next week. Market was hanging in there pretty well at the top, but it did that similarly at the start of February when the market rallied up to the top of the channel. And it got stuck there for a day, day and a half before it moved down. Now we're back there again. We're starting to roll over. You can see the falling top starting to build. And so that tells me we're more likely to move lower than higher. Now, of course, we could consolidate here and then break out, in which case we have to take the bullish stance. But for now, the more likely move is to the downside. Looking at the longer-term weekly chart, you can see, as we've discussed many times, that falling top exists there on the weekly. The long-term upward trend, that one was broken. If we looked at the 5-year, it looks more like that. Either way, we've fallen below that long-term upward trend line from a falling top. That's a pretty strong sign that the market is more likely to go lower in the weeks ahead. Again, not a certainty. We could rally up to the downward trend line still and then roll over, or we could pause here and then roll over. And there is that possibility, not a probability, but a possibility that we move back and go to new highs. I would say the bullish outlook is maybe a 20 to 30% chance, while a bearish outlook is in that 70 to 80% chance. The only question is, how long does it take? Does the market rally up and then go lower, or does it pause here for a little while and then go lower from there? That's what we have to watch for. On the Russell 2000, had a good week this week. It was up. However, it is below the downward trend line. Wouldn't surprise me at all if this came back up to the downward trend line before moving lower, because it is oversold. It's sort of at the bottom of the channel right now. and that's a possibility where we could get a few weeks of strength before it continues in that downward trend. But either way, I would consider this a bearish chart. Toronto Stock Exchange, a little bit better than the S&P. We talked about this last week. We have some rising bottoms in place, and then this week, of course, had a decent upward move, and that's because oil stabilized a little bit. Gold has been doing well, and that has helped the Canadian market. But here you're seeing on Friday some of that weakness that comes with oil starting to roll over. We'll look at the oil chart in a moment. And really, we're just at the top of this channel. I mean, you'll notice I've drawn a line across these bottoms, and then I draw a parallel line across the tops, and we're basically oscillating around in this channel, which means probably moving lower in the near term. Longer term chart, we're also running into that resistance at the top of the downward sloping channel there. The downward trend line should hold up. So we've had a decent 4 or 5 weeks to the upside because the market was very oversold here, but we're now at that trend line, and what usually happens is the market rolls over and moves lower. And I think you'll understand why in just a moment. I'll explain. The TSX Venture, this is a weekly chart. Usually I show a daily chart of the TSX Venture, but I opted to show a weekly one because you can see that the downward trend line was actually broken this week. Not really from a rising bottom, so I wouldn't consider this a very bullish outlook, but it's certainly better than we've seen for such a long time because this has been such an ugly chart for a long time. This mostly because of the strength that we've seen in gold. And will that continue? Hard to say. We'll talk about the gold chart in just a moment. Treasuries had gone parabolic. We talked about that last week. It had what I call a bursting bubble candle right there, pulling back, and it's now come back to the linear trend line where it bounced. And I think part of the expectation that I get from this chart is that money is still looking for safety. It had been sort of hiding out in treasuries, and then it pulled back a little bit because treasuries got overextended. But now that the market was starting to roll over at that resistance level again this week, you're starting to see some money come back into the safety of U.S. treasuries. And that, to me, is a bearish sign for the stock market as well. U.S. dollar moved down a little bit on Friday. This is a weekly chart, so you don't really see that. It's a very minor move this week, kind of stuck inside the range. But this is I would say, a slightly bearish chart. It was a pennant pattern, and we had the breakdown from the pennant there. So it looks to me like U.S. dollar probably goes lower. I don't know if it goes a lot lower, maybe down to that region there. That's good for commodities and maybe actually stabilizing for the stock market, but I don't think it's a real strong factor right now. Here's the gold chart, and again, this is the weekly chart, and let's just draw that downward trend line, which you can see was broken 3 weeks ago, and not really from a rising bottom. It held up well this week. We had some profit taking early in the week. If we were to look at the daily chart, you'd see that it was going up. It pulled back, and then at the end of the week, it started to come back up again, which is why we're now in this sort of inside the range of the previous week. I would say it's a relatively bullish short-term chart. Longer term, you haven't got that build of a rising bottom yet. You still have a lot of pessimism to overcome. And so at best, I give this a neutral rating on the long term. I do like that the downward trend line is broken. I just think it's going to probably have a pullback and then move higher first. Now, that pullback could come once it gets to 125 and then pull back. Never know. But very rarely do you see markets make V bottoms. They usually make a downward trend, a break a trend, a pullback, and then eventually breaking to the upside. So I think it's going to take some time for gold to materialize longer term. Short term, we could get lots of volatility in gold. We've certainly seen that. Here's a chart of oil, and we had moved to new lows there. But we moved to new lows after a fairly strong move to the downside. So essentially support held. It kind of got broken for a day, and then it's held back. And I would consider that to still be support. But notice, and I can go back a long ways, falling top, falling top, falling top, falling top, falling top, falling top, falling top. Again, this week we started to roll over on Thursday, and my guess is we probably retest that low, and that will be a factor that drags the market down. Now, if the market for oil can in fact make a rising bottom here and break the downward trend, that's not what will probably happen, but certainly what could happen, then that would be supportive for stocks, help stocks break through that resistance level at the top of the channel, give the Canadian market a little lift, and really basically form a little head and shoulders bottom here. Again, I don't consider that the probable outcome. That's a possible outcome, but something to watch for. Most likely, we move and test the lows again on oil next week. Fear index been tailing off as the market stabilized, and with a stable market, volatility diminishes, and that's really what the VXX is all about, is a gauge of volatility in the futures market for the S&P 500 futures. So the VXX pulled back all week, tried to make a little bottom on Thursday, kind of failed on Friday. We'll see what happens next week. If oil does move lower and drag stocks down, I think this will bounce and continue that cycle of rising bottoms. But it's a little bit worrisome if you're long on volatility right now, because the upward trend line was broken on Friday. So not broken from a falling top, it's broken from a new high. So I still think this looks a little oversold. My gut is that we're more likely to see a down move in the market, maybe a little rebound in the VIX, and some weakness in oil. That's sort of how I think next week will shape up, but it's far from certain. It's a little bit of a tough call going into next week. So outlook, U.S. stocks, I am bearish long-term, neutral short-term. Canadian stocks, same story. Gold, neutral long-term, bullish short-term. We've had some good action there, obviously, but we haven't really broken that long-term downward trend yet. Oil, bearish long-term, neutral short-term. It is trying to stabilize, but I think there's a decent chance we move to new lows here. The markets have been stabilizing this week, but have not broken the pessimism. Gold has been strong, and that indicates that investors are seeking some safety with expectations for turmoil in the future. Oil continues to drift lower, and that could move to new lows next week. So that would drag stocks down. Keep an eye on that. Trade cautiously until trends are broken. I would say take a short-term view of the market. Trade the volatility. That's a good way to make money right now. But just don't believe in the long-term trend reversal just yet. That has been the Stockscores Market Minutes for February 22nd, 2016. Have a great week in the market and trade well.